Ladies and gentlemen, welcome to the podcast, The Joyful Frugalista, and now here's your host, Serena Bird.
Hello, I'm super excited to share the good news that I have written another book, How to Pay Your Mortgage Off in 10 Years, responds to the cost of living crisis that many people find themselves in. Whether you are paying off a mortgage, you've paid off a mortgage, you aspire to buy a house and have a mortgage, or you know someone who does have a mortgage, this book will have lots of frugal tips and tricks as well as some finance hacks for you. Thank you so much. Yuma Frugalistas, and welcome. Today I have a special guest, and of course all of my guests are special. Today we're going to talk about property, but not just property. In particular, we're going to talk about buying property and getting a home loan. And who knew that this could actually be a happy topic? Because it can actually be. But first, I have a favour to ask of you. If you enjoy this podcast and find it useful for you, please pay it forward by sharing with a friend. And even better, please follow this podcast, The Joyful Frugalista. And I also love comments. Thank you very much. Aaron Christie-David is the Managing Director of Atelier, Weath, which he co-founded with his wife Bernadette several years ago. Aaron has a wealth of knowledge and experience in the finance industry. He's author of The Happy Home Loan, published by Major Street Publishers, who are also my publisher, so I really like them. So big shout out to Major Street. He's also dad to two girls, Sienna and Zara, and passionate about helping people achieve their home loan dreams and build wealth through property. So welcome, Aaron, and big congratulations on your book.
Oh, thank you very much. I really appreciate it. Thank you.
It is really easy to read, and I know we were speaking before we got on, but often when people are talking about home loans, particularly before they get their first one, it seems really complex. There's all these different products on the market, all these different things. And it's rare that you find something like your book that really makes it easy to digest.
Oh, thanks. I appreciate that. And that was the premise. If people can come away from reading the book going, a home loan doesn't feel as intimidating or daunting. The word that I've coined is bankxiety. So it's anxiety. So the anxiety of dealing with a bank. And that's common, like I'd say that's probably people's biggest fears, which is, I'm going to apply for a loan, and what happens if I get declined? And it sounds irrational, especially to someone like us who's a mortgage broker going, my decline rate is like 0.005%, which means very rarely does a loan get declined. Okay. But I guess you hear about all the horror stories, and they're what kind of take a lot of the noise and attention, which is someone got their loan declined, whether it was a friend of a friend or someone that you know. If you peel back the layers on that loan application, it probably should never have gone to that bank to begin with. So it could have been avoided, and that bad experience could have come away. So there's so many people that have wonderful, smooth experiences. Now, dealing with the bank is clunky. That's generally why mortgage brokers exist, and mortgage brokers are writing in excess of 70% of all home loans across Australia. So the proposition has certainly struck a chord with more Australians because it solves a pain point, which is, hey, can you be the buffer between me and a bank? And that's what we do.
You mentioned that there's very, very small percentage of cases where a mortgage is actually declined by a bank or a financial institution, because increasingly there's a lot of non-bank lenders in the system. What are the sorts of reasons why something might be declined?
Yeah, it'd be something that probably catches everyone off guard. I'll give you one example. An unpaid telco bill that's lurking in your credit files.
Wow.
You just inadvertently. So the example is client was living in a shared house with a few friends. The bills were all in his name. He moved out to a new place, never got the bill. I mean, we're talking snail mail, but inadvertently just forgot it.
As you do?
As you do, right? You don't even think about it. And so when he went to apply for the loan, I was like, that was 2 years ago, but it's hung around in his credit file. And the bank said, hang on, an unpaid bill, utility bill, we're going to decline. And there's two types of decline here, Serena. You've got a hard decline and you've got a soft decline. And so what happens is, because we can provide evidence that he didn't know about it, he moved to another place, he's had a squeaky clean record, never had a history of paying bills late or not on time, the bank was unable to say, okay, I can understand it. And so the decline actually gets overturned. And then it comes back to, I guess, how organized can we be as brokers? How much detail can we put back into notes? Okay, if it doesn't work with that bank, can we find an alternate bank as well? So the decline is not the end of the world. It can be a speed bump, but then you get things like a decline being the bank won't actually take that specific property because you've bought a really high density postcode, or you've bought so close to a train station or a power line, and that bank just won't, even if you've got a pre-approval, when you go to buy and you find the property, the bank will not accept that particular style of property. So they may decline it on that basis as well.
Yeah, I'm always surprised by these different types of criteria. I have an investment property which has always had a really good rental yield, but it's small. So it doesn't fit the criteria for like a top tier lender. So I can get a product for it, but I can't always get the best possible deal. I've actually got around that now by cross-collateralizing with my home, which I know a lot of people say don't do it, but I'm like, yeah, well, it gives me a good interest rate, so why not? But, in the past, it's been really hard to get a mortgage for it, even though it's rented really well, everything's fine, but it's just smaller than normal.
That's right. I mean, and this is rules are rules. So it doesn't matter how well performing the asset is. In this case, there's properties that are under 50, 60 square meters that banks may say no to. That's cool. Someone else will. And so you just got to keep knocking on enough doors to go, which bank will accept it? Because there are lenders that will take properties for less than 50 square meters. And like you've done there, you just may be restricted in who that property can go to. That's all.
Well, that's good to know. And I guess a good broker like yourself can explain those reasons. And people might even know about it before they even apply, so they don't have that problem.
Yeah, correct. And then you go back upstream and it's like, well, if you can only really go to 2 or 3 banks, then you've got to be able to meet their eligibility criteria. So if you have 2 or 3 out of those issues, so I'm casually employed or I'm self-employed, and you don't have the pick of lenders, then you've got to effectively deal with the cards you're being dealt. And it's like, right, where are we going? Which lender's going to say yes? How many boxes do we need to tick here, for example? And I think that's when people are trained and conditioned to buy a loan on the lowest interest rate. We're going, hang on, the rate's not important if you can't actually get the loan. We've got to be policy driven first. We've got to be property driven next, and then we can be price driven. And once people can kind of understand and connect those dots, it makes their home buying and loan buying experience much more seamless as well.
Yeah, they're all good points, because what you see as published isn't always what a first home buyer who doesn't yet have a good credit history and perhaps needs to borrow a lot can get. Is that right? In my case, due to my background, I'm usually able to get those kind of published rates, but not everyone can, I know, and sometimes it's a bit of a struggle just to get a loan at all.
Oh, correct. There's some people, I mean, they've been casual for some time now. That's not an issue. Some people think they've got these are some of the mortgage myths that I've spoken about. They think that I've just started a brand new role, I can't get a loan, I'm still on probation. That's such an old wives' tale, which is, hey, I can do day one on the job with some of Australia's biggest banks. You're being casually employed, no problems. You got contract employment, no problems. You're self-employed, no problems. You've had a career break, or you're on maternity leave or paternity leave, no problems. And this is the beauty, I guess, of having a depth and breadth of lender choices and options. And, we've been doing this for a number of years. So it's rare that something comes across our desk that we haven't seen. And quite often we'll say, most people, as soon as we answer the phone, go, my situation's a little bit complex. I'm like, yeah, keep going, because we've generally heard it before. And that's the beauty of when you're dealing with many mortgage brokers that have a good amount of experience or good amount of tenure or depth in what they've been doing from a volume perspective. Like they've seen enough to go, I pretty much know who we can go to or where we could kind of knock on a few doors from a bank perspective as well.
I guess you've got that relationship as well with the lenders, so you know how they operate and what they're looking for.
Yeah, correct. And so and relationships, like anything in life, it's a who you know world. Yeah. So you can get 2 identical loan applications that go to a bank. One could get approved and one could come back with plenty of rework. And brokers get reputations inside banks because credit assessors, there's only so many credit assessors inside a bank. And so when we submit an application, not tooting my own horn, but when I say really, really good brokers, when they submit applications, they know which boxes to tick. They know the level of detail that a bank, because your application is going to go in front of a human being that has no idea about your story, right? As a broker, I've spent time getting to know Serena and her aspirations and her career and her income and her living expenses. So that all these hours of conversations that we've had, to try and condense that down to something that a credit manager or a credit assessor can understand, that becomes vitally important. And that's something that gets overlooked. And so if brokers submitting poor quality loans, they get a reputation that they submit poor loans. Whereas if you're a broker that has high submission quality, that means your deals move through much seamlessly as well. And they go, yeah, I can understand that you've got a pattern of submitting good loans. That all stacks up in your favor as well. And that sounds very hard to quantify. If I told a client I have high loan submission quality, like, what does that even mean? But when you say, hey, look, there's attention to detail that when your loan goes to a bank, that we know exactly what a bank needs to see to approve a loan, that's something that then you can kind of make a little bit more tangible and understandable for a client as well.
So a client's thinking of applying to a bank or a non-banking lender. What are the sorts of things they need to be doing first before they're even filling out that form? What are the sorts of things that they need to have in mind?
Yeah, I love it when people come to us when they're thinking about buying. So what that means is we're understanding where are they at in life, and there's different cycles and windows, isn't it? So like where you probably were single is very different to where you are when you're double income, no kids, to when you're double income, double with kids, when you're trying to renovate. Then we deal with upsizers, for example, that are moving for specific school catchment areas. And then you've got the empty nesters that are in a too big a house that they need to downsize with a bit of dignity. And then you've got the retirement phase. So their requirements are so different at each of these different stages and phases in life. And we're trying to understand, okay, so where are you? What type of property are you going to look to buy? How long do you intend on maybe being in this property? And then what happens when you want to either keep it or sell it? And people don't even understand because they don't have those answers because they're like, I just need to get into the property market. I just want to buy now. What are you going to be a handbrake and ask me all these questions for? Like, that becomes very, very important because if you're going to buy, renovate, sell, it means that we may choose to go for, I don't know, maybe an interest-only loan for a short period of time, try and get you better borrowing capacity, that you've got extra funds to do the renovation work versus like myself, which is I'm going to be in this home for a very, very long time because I've 2 small kids. And we love the area that we're in, so we've got no intentions to move, but we may have intentions to renovate at some point in the future. Okay, great. Well, how do we rapidly pay down our loan, or how do we get some extra equity out to then go and do a renovation? And by asking questions, by being curious about someone's situation, by not just hunting the lowest interest rate, by taking time just to be a little bit more organized and prepared, this is all that pre-work that happens before even a loan goes into a bank that makes sure. I mean, we've got something called best interest duty as a client, but it's not even that. It's just going, I genuinely care about who I'm working with. Let's get to know each other, that we're a right fit and that we can be that long-term partner for you as well.
I agree that it's really useful to be able to talk to someone before you go and buy a property. In my case, when I was selling the former family home and I was at that point a single parent and looking to buy somewhere that was closer, that would reduce my commute and make my life easier, one of the best things I did was have that conversation because I thought I could have borrowed more than I actually could have. And my lending criteria had changed just by the fact that I now had 2 dependents and I was a single parent. And also too, I still had properties together with my ex. So it meant that I was sort of still, I guess, 100% liable for the risk in a sense. So I was still in that transition phase. So just having that conversation was really useful because that meant then that I was really confident about what I could actually buy in what range and also to not to get too excited about other things. So it saved a lot of problems down the track.
Spot on. And I think you've nailed it there, which is generally people go hunting for properties before they've got finance sorted out. So, to then say, look, I don't think you can afford that price range. You don't want to be a wet blanket. Be like, look, you can't afford those properties is a very hard conversation to have. Whereas if you manage expectations at the front going, this is where your borrowing capacity is, here's where your savings are, therefore your purchase price is X, it almost then self-nominates where and what they can look to buy versus they've got their heart set on a particular area or a particular type of home and then suddenly it's like a back to reality here a little bit. Yeah, as much as we want to make dreams come true, we've then got to be able to play within the confines of how much you can actually borrow comfortably as well.
Because it can be so hard. You do find your dream home and you can imagine yourself there. You can imagine your children growing up there. It's like really close to a great school, like particularly if it's in the right catchment area. And I'm in a category A school area for the particular school they're at. So, that was a key consideration too. So, all those sorts of things, and they all line up and you love the colour scheme and everything's fine. And then it ends up being other people have decided they like that property and it ends up being a lot more expensive.
Great. And just that entire process, part of the experience is what the property is listed for versus what it actually sells for. Like those goalposts just continue to move. And that's probably what a lot of people, especially when we're dealing with people that are pre-approved at that point, that's where you start to see the wind come out of their sails. That's where it really probably gets them really despondent and stressed out about the home buying journey, which is we've got a budget, we've got a pre-approval, but every property that we're looking at that we love is going for well over its listed or asking price, or the auction result just blows us out of the water. And it's hard to say, well, then you need to readjust the purchase price range, or the fact that these properties are just significantly underquoted and they were never going to sell for that because the agent is underpriced or underquoted that listing to get more people coming through. It's not a dig at an agent. We've got great relationships with agents, but it's a very common marketing tactic, which is, hey, drop that price back a little bit and then get more interest through the door and then watch that price start to increase. And so we're never going to change that behavior. So let's change our behavior, which is then let's get more realistic about looking more on the sold tab than we do on the for sale tab.
Yeah, it is a hard one too. And in a fast rising market, agents are often like, we had no idea it was going to, like the market was going to explode like this. It's really hard to get the pricing right. Like if they put the pricing up too high, like no one will be interested. If they put it too low, it's not quite right either. It's a really difficult thing. And the market's all about supply and demand. So it's constantly recalibrating.
Right. And what some people don't realize is that particular, like say, for example, where you may have bought, imagine your parents are 10 minutes away. The school is 5 minutes away. Your office is 10 minutes. There is such a premium attached to that property that I will pay whatever it is to buy that. And so you may be competing against a buyer that is very more emotionally invested in buying that particular spot because it ticks all of their boxes, right? Because it's close to family, close to transport, close to this, close to schools, versus you may be a little bit more agnostic to some of those elements about the property. Therefore, your value of that has gone down a little bit, but their value has gone up. So that's where it's subjective. And I even talk about this in the book. People really despise the auction campaign or the process. I say, look, flip it on its head. It's actually the most transparent process there is. You get to see your competition. You get to see how much they're willing to pay. It's fair market on the day. Whoever's got the money will afford to buy that property as well. So rather than the games that agents play, which is, oh, we've got an offer, and everyone says, but actually, do they have an offer and do they actually have to disclose it? You're able to see firsthand who your competition, how much is they're willing to buy. So again, if we can reshape how people feel about, and yes, it's intimidating. Auctions are nerve-wracking, stressful. Our property went to auction. My palms were sweaty for the whole week. And I don't think we slept much that week because you're like, it's out of your control. You just don't know who's going to shop on the day. You put your best foot forward, but if it goes out of your budget, it's out of your budget and you're back to square one. And I say, look, if it was selling for that over your budget, it was never yours to begin with, which is a hard truth as well. But just anyone listening that goes, I hate the auction process, or knows of someone that has that rhetoric, reframe that, reshape that to go, it's a transparent process, and make peace with it as well, because auctions are just not going to go away.
No, they're not going to go away, and for various reasons, real estate agents like them. I think it forces things to a conclusion, and there's often auction fees associated with it, but it's something that's not going to drag. And look, I hear you. And I'm laughing a little bit because when I bought my current home, which I bought via auction, I was at a kid's birthday party where one of the school dads was talking about his strategies, and it was very much a sort of, not quite an alpha male, but very much a confident male strategy of, and I'm going to do this and I'm going to do that. And when I actually did turn up to auction, it was actually most of the people bidding were actually women, which was really interesting. So it's often not what you think too in terms of the bidding.
Yeah, correct. And the amount of time that we have people that turn up to the one that they want to buy, and that's their first auction they're going to. I'm like, this is wild.
Yeah, I know.
Right?
Sometimes often $1 million decisions that is going to be their biggest investment in, even bigger than their superannuation, the most significant investment, and they don't go to others beforehand.
Yeah, so we're always saying, like, you've got to turn up to auctions. You've got to some of the auctions, so find out who the auctioneer is going to be. Look up their auctions on their Instagram. Like find out some other auctions that they're running and get a feel for how that auctioneer likes to run their campaign on the day. Turning up to other properties, like the nerves will then, like you're a little bit more in line with like, okay, what's my strategy? Do I want to be aggressive? Do I want to sit back and be the sniper at the very end? Am I going to wait for someone else to go and then kind of make myself known? And what increments are bids going up by? Are they going up by 50, 60, $70,000 increments at the start and then dropping away to 5,000 increments? That's when you know it's starting to slow down as well. Or do you engage a buyer's agent who has that service of auction bidding and you go, I'm paying someone to turn up. It's a bit like a success fee. And can you imagine when someone shows up with a buyer's agent? It's a strong showing. I'm paying someone to turn up to bid for me. We're stacking the odds in our favor. And they will know how to, because they've done that many auctions, they will know how to read the auction, read other bidders just going, that person has an infinite supply of money because they're downsizers and they've sold their property and they're going to have cash left over. You're playing with fire here effectively versus how you compete against other first home buyers. I reckon we've got a chance here as well.
Yeah, this whole investors versus first home buyers, it's such a fraught thing. Like I know a lot of first home buyers get very upset about investors being at auctions. And I read somewhere recently that the percentage of investors attending is actually increasing. So it's showing a bit of a trend. Why is it that first home buyers feel so, well, maybe not threatened, quite the word, but anxious about this?
Yeah, I mean, it's competition is a big part of that. Investors usually have more money, but investors will get to a dollar figure and they're out because they're just going, look, at this point, the yield doesn't make any sense or I'm gonna overpay. So the beauty with investors is they'll get to a point that they're gonna fall off if it gets to a dollar figure. Whereas a first home buyer, if you've got the borrowing capacity, you can scrape get a little bit more money, for example. You can pay more mortgage insurance if you need to. There's ways, but then if you're outpriced, and that's where generally a lot of first home buyers have got despondent, which is investors just come in, they're more experienced, they're more seasoned, they've got more money, and they're going to be able to come in here and cut the legs underneath a first home buyer. And it's going, well, how is that fair? I'm trying to get in. You've already got property. And unfortunately, yes, it's a very socialist view that, hey, look, we should be trying to get more first-home buyers in. This is a capitalist country, and the odds are more leaning to people that are property-backed. Banks will give them more money, for example, and it's a message that I keep beating, which is buy what you can, where you can, when you can. You won't regret buying in there. You won't overpay because the property market continues to do its magic and increase year on year, which no guarantees, but the performance of the property market just shows that by sitting on the outer, I mean, I did an interview with someone recently who said property prices increase by $1,600 a week. You can't physically save that money, particularly if you're renting. And when you think about that, property prices are increasing on average by $1,600 a week. Sydney's doing far more because Melbourne brought that average down. So Melbourne's doing $500, Sydney's doing almost $3,000 a week. And it's like, if you can't save that, then you've got to be able to jump into the market, and that property will then automatically be like forced savings for you as well by paying the mortgage, no more rent. And I think even you and I were chatting before, which is there's a level of security that comes with having your own home.
There is indeed.
And something worth paying a premium for.
When we're talking about a rising market, and which it seems that it surprisingly still is, even with higher interest rates, at what point do you recommend people just to jump in there and, maybe pay the lender's mortgage insurance? In fact, some people probably might not know what that insurance is and what it covers.
Yeah, so if we answer that part, when you don't have a 20% deposit to buy a property, you will have to pay lender's mortgage insurance. Look, on average, it's about 2% of the loan amount. So if you kind of work that out, banks will let you add that into the loan, so you don't have to pay that out of pocket. That is a protection fee for the bank that they're taking a risk on a borrower that doesn't have a 20% deposit. It's very rare that we get first home buyers with 20% deposits. Yeah, maybe they've got the bank of mum and dad in their favor. Maybe they've been able to sell shares, whatever it is. But if you're renting, it's very hard to save for a 20% deposit because as you're saving, the property market, like we're saying, is just increasing over time. So lender's mortgage insurance is the ultimate shortcut to get into the market. So people can make peace with paying an extra fee. So yeah, you've got stamp duty, legal fees, bank fees. This is another fee. So if you see this as a cost of doing business to buy, bite the bullet get in. Now, if you're one of lucky few professions, so more accountants, medical professionals, lawyers, for example, they're entitled to buy a property at 10% deposit without paying mortgage insurance.
Oh, I didn't know that. That's really interesting.
Again, it surprises some professionals that we speak to going, hey, mate, you're CA qualified. You can buy a property 10% no mortgage insurance. That goes for buying your home and investment property. And that, it's I could complain, why aren't mortgage brokers or whatever it is in that mix as well? But the banks go, these are occupations that are safe and stable, and we want to reward them. And generally, they borrow more as well. And so the banks will incentivize those type of borrowers to come in and offer them 10% no mortgage insurance loans too. Some banks will do an 85% no mortgage insurance loan for first-home buyers. Again, you don't ask, you don't get. So trying to find out, what loan limits there are on those, what criteria is there on those type of campaigns and offers as well. Always worth asking the question. So mortgage insurance is simply a vehicle to get into the market. And understanding what's involved, I think becomes part of that due diligence process that you speak to, whether it's direct to your bank or through your broker. Ask the question. Yeah,
that does make a big difference. And so for those who are considering going in, this is the advice that Aaron has. Get into the market. So get in at some point, which brings me to another kind of question that I have for you, which is perhaps when I bought my first place, it wasn't always the sort of place I had expected to be my forever home. But increasingly younger people are waiting and are building or buying a nicer quality house, not necessarily a small unit fixer-upper in the outer suburbs. Is this a good trend? Is it a bad trend? What do you recommend first home buyers do?
Yeah, so what you've got there is two types of properties. One is I'm going to buy the unit, I'm going to get in there, fix it up a little bit, and then try and turn a profit, and that's going to give me my uplift to buy the next home. That's what I call a stepping stone approach. So this one's going to get me to my next one, hence it's a stepping stone. Versus someone's going to wait to then buy a bigger home. It's what I call a stretch property. They're going to stretch themselves a little bit more, which means they're not having to buy, sell to then buy that next property. So the reason they go stretch property is because they're not having to pay stamp duty, they're not having to pay agents fees on the way out, and the cost to renovate, for example. And what market do I sell at? I don't know what the future holds. Whereas I just want to get in and I want to have that one move in me versus having two moves. And it's a bit like any type of game of chess. Like it's a tactical play. You don't know what's on the other side. Generally for option two, you're going to need some pretty good incomes to buy. So the way that we work out borrowing capacity is you take your combined annual incomes, you times it by about 4.2 to 4.4-ish, generally tells you how much you can borrow. And when you think back at the height of COVID, we were getting people that were borrowing 7-8 times their combined annual income. So that's how much borrowing capacities have contracted.
Wow.
Due to interest rate rises and the rises in cost of living and living expenses benchmark. When you tell that to people and you're like, that doesn't make any sense. Borrowing capacities have fallen by 30, 40%, but house prices have grown last year at 9% on average around the country. It blows people's minds. And you can understand why we're perplexed going, I thought 13 interest rate rise was meant to halt property price growth. And the latest data has come out this week going, Sydney again has just shot up in value. It's like, what will it take to stop house price growth if 13 interest rate do it? I can hear that. But then again, COVID saw massive house, price growth. The GFC was a mere blip for property prices in comparison to, what it could have or should have done. So if you're sitting there and waiting for this right time to buy, if you're sitting there waiting for a correction in the market, unfortunately, it's just not coming. The market's not slowing down for anyone. It's going, hey, the property market rewards action takers and decision makers. And unfortunately, there's people that are waiting to get in that have been waiting for years that are now being priced out.
Yeah, it's very hard for a lot of people. I know. And yes, so the moral there is don't wait until we get a slump because it may not happen. So get in quick. Now, I have one final question for you, which is a question I ask all of my guests. Do you have a Frugalista tip to share?
I have plenty to share. Look, I've got two small kids. I've got 2 daughters, 3 and 5, and they want to go for cafe breakfast. I'm like, I'm not spending $90 for a cafe breakfast sometimes. So for one, for me is we'll go to a park and we'll get a takeaway coffee and a small cookie, or sometimes even bake our own cookies, which gets them involved. So we don't want to be spending unnecessarily at a cafe. That breakfast could set us back $100 for my wife and I.
Easily.
Easily. You bat an eyelid and the juice is like $13, right? So, and they don't even drink it all. So we've got into the habit now of less cafe. That's one. The other one is, we've got a lot of memberships. So, I've got my finance industry membership. We've got NRMA. We've got Telstra membership. And we're always looking in those awards programs, all those VIP client programs that we've got, to see what access we can get to an amusement park or to do something with the kids where we can get a discount. And it's like, hey, mate, we've already paid for a membership. Why aren't we making the most out of that as well? And I'd say to the people going, if you've got NRMA, if you've got any type of industry body affiliation, they've got member benefits. Telstra, Optus would have it all. So use those.
That's a good one, because so many people have them and they forget about them. They're like, oh, yeah, I forgot I could get 5% off at Woolies, or I forgot that I could get a bit of money off from my petrol. So, use
petrol, them. $10 movie tickets, whatever you've got, mate, they've got to try and give you some of a bonus for staying a customer, right? So make the most of those little offers.
Wonderful. Well, now where can people find you? Now your book, I'm guessing, is everywhere.
The book, I'm hoping it's everywhere. It's on Booktopia at Amazon, airport bookstores, Harry Hartog, and some Dimick. So it's find it on our website as well. And look, I'm happy to give you a couple of copies. So if any listeners have loved the podcast, you want to reach out, send yourself or myself a DM. I'm happy to give out 5 copies if you like, some of your listeners. So let's do that. And then if you want to hit us up, check out atelierwealth.com.au. People can reach us there, or I'm usually pretty active on LinkedIn as well.
Wonderful. And thank you so much for that book offer. So I will add details of that when I share it on social. So in fact, I'm going to put in there that people have to work for it a little bit and maybe say what makes them feel happy about a mortgage.
I love it.
Thank you so much for being my guest. I really appreciate it.
Thank you so much.
You've been listening to The Joyful Frugalista with Serena Bird. And of course, sound has been by Neil Hadley.